Hello and welcome to the Market Lens. I'm Sam Rozzi, manager of Due Diligence. As usual, I'm joined by Cliff Walsh, our Chief Investment Officer. If you've missed any previous episodes, please check them out on YouTube or the Studio 454 video library. This will be our last episode before the AP National Conference, and we're looking forward to connecting with everyone virtually. Let's start our news or noise segment today talking about consumer sentiment. Consumer sentiment is at its lowest point in more than a year, taking a heavy hit in August and stabilizing at that low level in September. Retail sales did bounce back in August, though, after a dip in July. It seems to be somewhat conflicting. Do you think this is news or noise?
I've taken most of this year's economic data with a grain of salt. As we've talked about in the past, growth rates and comparisons are kind of pointless when you're shutting down and then reopening the economy. The consumer sentiment data is newsworthy, though, in my opinion. We'll wait and see what the September retail sales data looks like, but I will say that the data you provided is perhaps not as conflicting as it might appear on the surface. First, the growth in August came on a notable downward revision in July data. Second, all of the growth came from positive seasonal adjustments.
Yeah, I would say it's really difficult to take any month coming out of the pandemic and apply historical data trends for seasonal adjustments there.
Exactly. Before these adjustments, sales month over month were down 0.7%. Looking at August data prior to the pandemic, seasonal adjustments have never added anywhere close to a 1.5% swing. The data is wonky, and the underlying spending in the economy is not as strong as the headline suggests.
So what does the future bring here?
Consumer expectations for the future did pick up a touch in September, perhaps implying that the current pullback in spending is temporary, possibly waiting for inflation to ease before making some large purchases, but that's only speculation. This is an item to keep a close eye on when the data is reported in a few weeks and throughout the rest of the year. My sense is that consumer spending is weaker than expected, and that should be newsworthy for equities, and it will impact the Fed.
Yeah, this is a great time to change our focus with the Market Lens zoom in. Let's look closer at the Federal Reserve. Last edition, we discussed its balance sheet, the economy, and the future of interest rates. Let's take a deep dive into the taper talk. What were your thoughts following the Fed's announcement?
Nobody was expecting the Fed to raise rates despite the current inflationary environment. So as you correctly pointed the lens, the issue is the taper. When will it start? How much will it be? And what will it be dependent on? And I think that's a key point. It is dependent. There is nothing set in stone. Chairman Bernanke threatened the markets with a taper back in May 2013. It didn't happen until January of the following year, 8 or 9 months later. In 2018, Chairman Powell discussed raising Fed rates to nearly 3%. We went to 0 instead.
So are you saying it's not going to happen even though they're saying it is?
I'm saying it's likely going to be less than planned, which market participants might view as good news. However, it would be a downturn in the economy or some other negative event that would keep them from tapering to the plan. The Fed revised down its 2021 GDP growth forecast to 5.9% from 7%. With 2 quarters down and a good idea of what to expect in Q3, the Fed's new forecast is actually implying Q4 growth of around 7%, higher than Q2. That hardly seems likely. The Fed forecast actually contained an uptick in 2022 GDP expectations, quite significant actually. Looking at the average of Fed participants, growth expectations increased to 3.9% from 3.3% on the heels of an uptick in expected inflation. My general sense is that the Fed is going to be disappointed in economic performance relative to their expectations, so this could mean they push out the timing of the taper or reduce the amount, which is still open for debate.
Okay, so what does this mean? What does this view mean for the market?
Well, it's probably not likely that the Fed will pull back on the taper before seeing the economic weakness. They're typically late to the game, but they have acted with more urgency over the past few years. I see the Fed tapering into a slowing economy. That's good news for bonds, not as much for equities, particularly at current valuations. But as you know, tapering is different than tightening. They're still providing easier financial conditions, but on the margin, it's less stimulus than the markets were getting. I think definitely a positive for bonds, mixed bag for equities. I think more important than the Fed taper is what happens in the next month or so in DC.
How so?
Last time around in 2011, the debt ceiling set off a pullback in equities. I think it was in the high teens percentage-wise, and despite the S&P downgrade of U.S. debt, 10-year rates rallied hard.
Okay, let's dive into DC swamp on the next lens.
Can't wait.
Back to the Fed real quick. What changes did we see in the dot plot from the last meeting?
2 additional forecasts for rate hikes in 2022 to 9, 4 additional forecasts for hikes in 2023 to 17. Follow the dot plot as a guide at your own peril, though. The dot plot has very little predictive power. I'd follow inflation. If inflation is transitory, as the Fed says, and I forecast it to be, It is unlikely that the Fed will be raising rates in 2022, maybe 25 bips if the economy is very strong. If you look at the futures markets for the February 2023 meeting, you'll see that about 40% of participants are betting on one hike, while about the remainder is split between no change and 2 hikes. Honestly, the outlook on rates is just not that important relative to the taper and what is going on in DC.
Thanks, Cliff. That's it for this edition. Thank you for everyone who joined, and I hope this lets you see 2020. Take care.